Welcome to Iron Financial. You know our mission here. We help you forge a stronger portfolio, and we do that by cutting through all the market weakness. Today, we're putting Victoria's Secret on the anvil. Their latest earnings report just dropped, and let me tell you, the numbers are telling a fascinating and, well, a pretty conflicting story. So we're here to break it all down, hammer out the facts, and figure out if this company's framework is actually built to last. I'm your lead analyst. And I'm your market skeptic. Look, let's just cut right to the chase here. Victoria's Secret posted numbers that, if you just glance at them, look absolutely fantastic. But the stock is selling off, and that is a major disconnect. So the big question we have to answer today is whether we are looking at a company with a truly solid load-bearing structure, or is this all just a polished facade that's hiding some really serious problems underneath? It's time to dig into the blueprints and find out what's really going on. Okay, let's just dive right into this, because this right here, this is the heart of the whole paradox. I mean, look at this slide. The earnings report was what we call a triple beat and raise. It's the holy grail. They beat revenue estimates, they beat profit estimates, and then they went and raised their guidance for the future. In the world of investing, that is the trifecta. It's a grand slam. You really can't ask for a better report on paper. But then you look at the other side of the ledger, the market's reaction. The stock just tanks, dropping 3.4% in pre-market trading. The contradiction here is what's so incredible. This wasn't some mixed report. It was a blowout. So why the punishment? Clearly, the market is looking past these beautiful headline numbers and seeing something it really, really doesn't like. And that's exactly what we're here to excavate. To do that, we need a solid plan of attack. So here's our agenda for today. First, we'll start by acknowledging the obvious. This was a beat, but it came with a pretty significant bruise. Then we're going to forge the top line, really digging into the revenue numbers to build out the bull case. After that, we'll stress test the very foundation with a profitability check. And then, my favorite part, we're going to go looking for the cracks in the portfolio, all those hidden weaknesses. From there, we'll analyze their blueprint for 2026 to see if their growth plans are even realistic. And finally, we will deliver the iron verdict, so stick around. All right, let's get to it and start by building that bull case. You simply can't forge a strong portfolio without first understanding the raw materials you're working with. In this case, that raw material is revenue. The top line is always the first thing we look at to gauge the health of any retail business. I mean, if customers aren't coming in the door and spending money, nothing else really matters, does it? So let's see just how strong Victoria's Secret's sales really are. Let's start with the big headline number, $2.27 billion in net sales for the fourth quarter. Now, this is a massive number, and it's not just big in a vacuum. It absolutely smashed right through their own guidance, which topped out at $2.2 billion. And it also blew past what analysts were expecting, which was hovering right around $2.23 billion. What this tells us right off the bat is that from a pure sales perspective, they absolutely crushed it. This wasn't just a slight beat. This was a decisive, powerful outperformance. And this chart, man, it just illustrates the momentum perfectly. This isn't a story of a company just barely clearing some low bar they set for themselves. No, we are looking at significant, powerful year-over-year growth, from about $2.1 billion in the fourth quarter of last year to nearly $2.3 billion this year. That is an 8% increase. In this current retail environment, with all the pressures on the consumer, posting 8% top-line growth in the critical holiday quarter, that is a sign of immense strength. It shows their product and their marketing are really connecting with customers. Now, let's dig a layer deeper, because this is the number that really gets my attention, an 8% increase in comparable sales. Now, for anyone new to this, comp sales measures the growth from your stores and your online channels that have been open for at least a year. Why does this matter so much? Well, because it filters out any growth that just comes from, say, opening a bunch of new stores. This 8% tells us that the core, the existing business, is getting stronger. More people are walking into their established stores, and more people are clicking buy on their website. This is organic, healthy growth. This is the very bedrock of a solid retail operation. And this wasn't just some holiday fluke. When we zoom out and look at the full fiscal year, we see the exact same pattern of strength. Net sales for the entire year were up 5%, landing at over $6.5 billion. And again, this performance beat their own guidance range. This shows consistent year-long execution of their strategy. It's not just one strong quarter, it's a developing trend of outperformance. So yeah, from a top-line perspective, the bull case here is rock solid. The structure looks incredibly sound. Okay, hold your horses. A beautiful building with a weak foundation is nothing but a death trap. Revenue is great, yeah, it's the flashy exterior, but it means absolutely nothing if the company can't turn those sales into actual hard profit. I've seen plenty of companies grow themselves straight into bankruptcy. So the real test, the load-bearing columns of this entire structure, is profitability. Are they actually making money from all this growth? It's time to check the plumbing and the wiring. That's a fair point, and you know what? The numbers back it up. Let's look at the bottom line. Q4 adjusted earnings per share, it came in at $2.77. The analyst consensus was looking for $2.47. That's a 30-cent beat. That's a nearly 10% surprise to the upside on the profit front. So this isn't just revenue growth, it's profitable growth. It shows they're managing their costs and driving those top-line dollars all the way down to the bottom line, delivering more profit for every single share outstanding. That is a sign of disciplined execution. And just like with sales, this isn't a one-quarter wonder. For the full year, adjusted operating income hit $403 million. Now, management had guided the market to expect a range somewhere between $350 and $375 million. They didn't just meet that guidance, they blew past the high end of it by nearly $30 million. So what this all means is we have a beat on sales, a beat on EPS, and a beat on operating income guidance. The profit foundation from this angle appears to be just as strong as the revenue framework. Whoa, whoa, whoa. Let's just hammer the brakes right there. Did you see the magic word on the last two slides? Adjusted. Adjusted EPS, adjusted operating income. That is single-handedly the most important word in this entire report. For everyone listening, when a company talks about adjusted or non-GAAP earnings, it means they are taking the real official accounting numbers and then they're subtracting out all the stuff they don't want you to focus on. They call them non-recurring or unusual items. The theory is that it gives you a cleaner picture of the core business. But my theory is that it's often just used to hide the ugly parts. It's like financial spackle they use to cover up the cracks in the wall. So the real question is, what exactly are they adjusting out of these numbers? And now, we get to it. This is where we take our sledgehammer to that polished facade. It's time to look at the GAAP numbers, the real numbers, the official numbers, with no adjustments. This is where we find out what was so big and so ugly that management felt the need to scrub it from the headline results. So let's look behind the drywall and see what cracks we can find in this portfolio. This, my friends, is where the story gets very, very interesting. And here is crack number one. And honestly, it's not a crack, it's a sinkhole. A $119.6 million impairment charge related to their Adore Me acquisition. Okay, let me put that in perspective for you. They bought this company in December of 2022. It's a recent, major strategic acquisition. And now, just over a year later, they are telling the market, oops, our bad, we overpaid. This asset isn't worth what we thought it was. A nearly $120 million write-down is a massive, massive red flag. It is a direct admission of a capital allocation screw-up of the highest order. But wait, it gets better. On top of that massive impairment, they also took another hit. Another $36.3 million charge for restructuring the fulfillment centers for Adore Me and another brand they got in that deal, Daily Look. So not only did they overpay for the asset, but the asset itself has operational problems so severe that they need to spend tens of millions of dollars just to fix the logistics. We're now at over $155 million in negative charges related to this one single strategic move. This isn't a small leak we're talking about. The pipes have completely burst. And this slide right here, this shows the inevitable fallout. Management has now initiated a strategic review of Daily Look. Now, that is corporate speak for, we want to sell this thing as fast as we possibly can. And notice the phrasing they use, a non-core asset. This is an asset they just acquired through the Adore Me deal. They bought a package deal and they're already trying to dump part of it while writing down the value of the rest. This just screams of a flawed acquisition strategy. It suggests they didn't do their homework, their due diligence. It's like they bought a house without getting an inspection, and now they're finding out the entire foundation is crumbling. Now, this is where the contradiction just becomes glaring. You have the CEO, Hillary Super, write in the press release saying, we delivered an exceptional fourth quarter. We enter fiscal 2026 from a position of strength. I mean, how do you possibly reconcile that statement with taking over $155 million in write-downs and restructuring charges on a major acquisition you made just last year? Is lighting $155 million of your shareholders' capital on fire your definition of exceptional? Is that what a position of strength looks like? This is the disconnect that has the market totally spooked, and frankly, it has me spooked too. Okay, you've made your point. The acquisition was messy, it was a botched job, there's no doubt about it. But, in construction, sometimes you have to tear down a poorly built extension to strengthen the main structure. And I argue that's exactly what's happening here. It's a painful, yes, but it's a necessary cleanup. The past is the past. What matters most for any investor is the future. So let's look at the blueprint for 2026. The company's own guidance tells us where they plan to build from here. This is the forward-looking part of the story, and it's what matters. And that blueprint looks incredibly strong. Let's break down this guidance because it really builds the case for the future. For fiscal 2026, they are forecasting net sales in a range of $6.85 to $6.95 billion. You know what the Wall Street consensus was? $6.77 billion. So they are guiding for revenue significantly above what analysts were even hoping for. Now, look at operating income. They are guiding to a range of $430 to $460 million. That's a healthy step up from the $403 million they just delivered. This is not the guidance of a management team that's scared or uncertain. This is the guidance of a team that is confident in the underlying strength of its core Victoria's Secret and PINK brands. They are signaling that the main building is stronger than ever. And that brings us to the final section. It's time for the iron verdict. We've examined the blueprints, we have stress-tested the foundation, and we've definitely found the cracks. We've seen the strong core structure, and we've seen the flawed new addition. So, putting it all together, what does this actually mean for an investor? Is the market's negative reaction just a massive overreaction, creating a buying opportunity? Or is it a legitimate warning sign of deeper issues, making this a classic value trap? This slide just sums up the entire debate perfectly. The bull case is clear, it's powerful, you've got that explosive 8% comparable sales growth, a clean sweep of beats on revenue and earnings, and a very, very bullish forecast for the year ahead. The core business is absolutely firing on all cylinders. But that bear case, it's just as compelling and it is impossible to ignore. A massive, almost $120 million impairment charge on a brand new acquisition, additional restructuring costs, and really serious questions about management's ability to allocate capital effectively. So here's my verdict. The market is focusing on the wrong thing. It's completely fixated on the sawdust and debris from a necessary renovation while totally ignoring the fact that the main structure is made of solid steel. That 8% comp growth tells you everything you need to know about the health of the core Victoria's Secret and PINK brands. That is the engine of this company. The Adore Me write-down, it's a painful, one-time cleanup. Good management recognizes their mistakes and they deal with them quickly. They are cutting away the weak parts to let the strong core grow even faster. The foundation is solid, and that positive guidance is the blueprint for a taller, stronger structure in the future. I see this dip as an opportunity. Well, I see it completely differently. You call it a renovation, I call it a structural failure. A nearly $120 million write-down on a brand new acquisition is not a cleanup. It's an admission of a catastrophic strategic error. And it calls into question the judgment of the very people who are drawing up the blueprints for the future. Sure, the core business might be strong today, but if the leadership team is making these kinds of multi-million-dollar mistakes in capital allocation, how can you trust them to build shareholder value in the future? This crack isn't on some cosmetic wall. It's in the very foundation of their strategy. It's a warning that any future construction could be just as flawed. For me, this is a trap. So there you have it, the bull and the bear case, forged in the data from this wild earnings report. The company has a powerful core engine and a very positive blueprint for future growth, but it also has serious, self-inflicted cracks from its recent acquisitions that call management's judgment into question. The final decision, as always, is yours. So the question we leave you with is this: is this a structure you're willing to build a position in? Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.